Hi everybody, this is John Wake with HomeSmart again. I have this terrible cold which is keeping me up. I think it's the decongestant or something, but I saw this. This is from the website of Lender Processing Services. Really interesting. It's showing that 2010 and 2011 were the best originations on record, or among the best on record. And these have different lines for different years, and it's showing the 90-day default percentage of all loans by vintage. So you can see for 2011 it goes out 10 months, and then for 2010 it goes out 22 months, etc. And this is the 90-day default rate in 2011, 2012 was extremely low. Let's look at 2005, the red line. 2005 prices were still going up in 2005, but they were giving out such crazy loans with those alt payment loans and alt A's and subprime, and so even though prices were still going up, they had phenomenally higher default rates even in these months. Look at this. By the third month, they were getting large defaults. That doesn't make any sense. Anyway, so that shows you that the quality of loans that they have right now is phenomenal. Let's go down and look at a little bit of something that's even better. These are low-risk home loans. These are loans that were very high credit scores and 80% down. There's like almost zero. That's 2010 and 2011. Zero defaults. It's extremely low. So if you're making those loans, I mean, that's got to be one of your biggest cost factors if something defaults. Here's ones. These are higher risk loans. These are people that had credit scores which were less than 660 and loan to value ratios of greater than 80. Still a lot less than in recent years. So you can see that, let's go back up, which goes to my theory that as soon as home prices start increasing, the money would magically appear for mortgages. Right now, their criteria is so stringent. They're getting great loans, great performance on them, very few defaults. But what happens when they say, you know what, we're making good money on these loans, maybe we should get more of these. How do we get more of these loans? Maybe we should loosen our lending requirements a little bit. And then they'll start lending out more money. That means there's more money chasing houses, and house prices increase a little bit. Now these are national. Can you imagine in Arizona where prices have, on average, have bottomed out and are increasing? Holy mackerel. The performance of lending is going to be really good for the next several years, would be my guess as an outside economist. And a lot of the ones their criteria are being set nationally, and so there's a lot of risk in other areas, a lot less in Arizona than just about any other place in the United States. And I ran into a credit union, a local credit union, which was starting to lend to people who were, if they had a foreclosure or a short sale, if it was more than 6 months old, they would still lend them money. So that's a real big change, because a lot of people like that. Now these loans were not 30-year fixed loans, they were variable rate, and you had to have 20% down. But you can imagine that that's a very low risk loan for that credit union, particularly as home prices start to increase. And if I were a buyer, I can think, well, you know what? It's not a 30-year loan. I can, in 2, 3 years, maybe I can get one then. Yeah, then you can get a 30-year loan, but prices can be a lot higher. So you could get a 3-year variable rate, 5-year, get it now, and lock in the great prices we have today. And then hopefully the interest rates won't be too crazy when you have to refinance at the end of the term. But I'm really, really bullish looking at how good the quality of loans are performing, and that there's plenty of room for lenders to loosen up their requirements. And when they do that, more people qualify, more money gets pumped, more money is chasing housing, and housing prices increase. Hey, this is John. Take care.